Regardless of the amount you plan to invest, whether that's £10,000 or £10 million, this video is exactly what you need to know. Warren Buffett is without a doubt an investment legend. Now a billionaire many times over, he started his portfolio at the tender age of 11 years old, with his very first stock purchase, which actually cost less than $120. The story goes that Warren bought 3 shares of a company called City Services at $38 apiece. Suffice it to say, he has come a very long way since his humble beginnings. His current net worth is estimated to be over $100 billion at the same time as topping a company currently valued at over $600 billion. The great moral to the story being that anyone can start investing at any point in their lives, whether you have a few hundred to a few $1,000s of savings. We are going to hear Warren discuss what he would invest if he had $10,000 to his name. Make sure you stick around to the end of the video, as there's a bunch of important information and tricks of the trade you are going to want to be aware of if you are starting your portfolio now. So let's get started.
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old. I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. I mean, you have to buy businesses. Or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about.
I think it's fair to say that the big message from Warren in this clip is about compound interest. Albert Einstein has been attributed to the old saying, "Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it." Whether this was actually Einstein who came up with this line is often debated, but the fact remains the power of compound interest is unrivaled. Warren Buffett's life, career, and now considerable wealth is a perfect example. Now listen to this lesser-known fact. Warren didn't become an official billionaire until he reached his 50s. A crazy 99% of his net worth was post-turning 50. I will say it louder. 99% of Warren Buffett's wealth was made after he was 50. Now, there is no question that Warren has been a phenomenal investor since he was 24 and working for his mentor Ben Graham in New York. However, one of the main contributing factors for Warren's jaw-dropping wealth and notoriety is simply that he has continued to invest successfully over a prolonged period of time, now well into his 80s and 90s. Have a look at this chart of Warren's net worth and age. This visual displays the true wonders of compound interest at work. Spot how at 59, Warren was considered to have accumulated a net worth of $3.8 billion. This shows an increase of $2.4 billion from the $1.4 billion he was worth at 56. Let's rephrase that. Warren gained more net worth over this 3-year period than he had made in the duration of his life up to the age of 56. Another thing to look at is that Warren has increased his net worth by over $30 billion from the age of 83 to the age of 91. During these years, he was averaging an increase of nearly $4 billion per annum. Again, this shows that during his later years, he made more in 1 year than he had in the first 59 years of his life. These are really shocking stats, but this is exactly how compound interest works. The gain in wealth is clearly exponential rather than linear. Let's take a look at the kind of impact compound interest has on a $10,000 portfolio. Here's our friend Jack. Jack is 25 years old and has just garnered an interest in investing. Aiming to build his wealth through a clever sustainable fashion business called Clothes.com. This is your one-stop shop to purchase the latest trends in sustainable fashion. These clothes are made from organic cotton and recycled plastic bottles, and yet they simply look amazing. Just look at this amazing website. If you haven't already, make sure you subscribe to this channel, the #1 finance channel on the line. Just stop what you're doing right now and hit that subscribe button. Research has shown that subscribers of this channel are 5 times more likely to become successful investors. But don't believe us. See for yourself and subscribe to this channel now. Now that that's out of the way, let's get back to our friend Jack. Imagine Jack's portfolio of $10,000 is invested over 40 years with a 10% average on annual return. Most advisors would say that 10% is generally considered the long-run average annual return for the US stock market. How much do we think Jack is going to pocket once the 40 years has concluded? Bearing in mind this is without Jack making a further investment, I would say his portfolio would potentially grow to $50,000, or if he got really lucky, $100,000. But with compound interest, Jack could have over $450,000. Jack would be able to grow his modest portfolio to nearly $500,000, all because he has compound interest work its magic. There are 2 main factors that decide how strong the results will be with compound interest: time and return. The real key to amassing wealth is to maximize both. I believe this is why Warren's best advice for how to grow a $10,000 portfolio is to start early. Reverting back to our good friend Jack, look what happens if we increase the set years by 10, running the investment for 50 years. $450,000 at 40 years, but $1.2 million at 50. Now, that's not to put you off if you aren't in your 20s. The critical element is to start as soon as possible. The other important variable that decides how much your investment will grow is annual return. For example, let's say that Jack can get a 12% annual return rather than the 10% we were working with earlier. It's only a couple of extra percentages, so one would assume it doesn't make an exponential difference. But see how it does. Working with a 12% return, Jack's initial 40-year investment grows to $930,000. Over double the size when the return was at 10%. Let's just play around with it. If we made the annual return 15%, the final portfolio shoots up to nearly $2.7 million. Now this even shocked me when I learned how much of a difference a small increase in percentage on annual return can make on your final portfolio size. This takes us nicely to the next part of this video. Using Warren's advice how we can maximize our returns, Warren has said on multiple occasions, had he been managing a smaller initial investment, he could produce annual returns of 50% or more. Now think how powerful 10, 12, and 15% was for our friend Jack. Just think how quickly your own net worth would compound if you really were able to grow with a 50% annual return. There is one very important change that Warren Buffett would make to his investment strategy that would enable him to garner those insanely high returns. He would predominantly focus on smaller companies. You might ask why, and the answer is this is actually very simple. Less of the other investors are paying attention to them, instead hedging their bets on larger, though arguably safer opportunities. As an investor, in order to generate high returns, you have to find companies that are extremely undervalued. As the company grows, naturally they generate more attention from both retail and professional investors. Also, as the following for the company increases, so as the company becomes more popular, it becomes less undervalued. While that all makes sense when you think about it, imagine you are looking to purchase a home or rent an apartment. You show up to tour the property and there are already 1,000 other people there, and they also want to offer. What are the chances of getting a below-market deal on that property? Obviously not very high due to increased competition. Compare this to showing up alone to tour a home that has been trying to sell off-market for months, unnoticed by the masses. The odds there are much better. A similar concept applies with investing. You want to narrow down on stocks that aren't as well followed and tend to get less noticed. These tend to be smaller companies. A famous investor called Peter Lynch has also discussed another advantage of investing in smaller companies. Logically, it is easier for something on a smaller scale to get bigger. Peter phrased it like this. Imagine you have 2 companies. One does $20 million a year in profit. The other does $20 billion a year. Which one is going to have an easier time growing their profit by 10 times? Odds are in favor of the smaller company to get to $200 million, an increase of $180 million. But starting from $20 billion to get to a $180 billion increase seems much more out of reach. After all, there is only so many people at work that can purchase a company product before that company runs out of potential customers. This is a fine example showing how it can be difficult for very large stocks to grow as quickly as smaller companies. So now you may be thinking, okay, this sounds great and all, but how could I find smaller companies that are worth investment? Well, I have the solution. It is called the stock screen. A screener helps you sort companies based on different characteristics you might be looking for. You might want to search by company size. Just using a stock screener that I managed to find on the web, I was able to set a filter for companies with a certain market cap. In this one, I set from 50 million to cap at 500 million, and that shows me a list of companies in that range. I can scroll through and look for names that look like they could potentially be interesting and narrow down my search further. I can go further by filtering by price to earnings, OPPE ration. Just say I want to see only companies that are trading at a PE ration of less than 10, but bigger than I. You have to go larger. Obviously, I don't want to see companies that are losing money with a negative PE ratio. Now, I have a list that is further filtered. These companies are small and some could potentially be undervalued. That's just an example of what I would try if I was looking for my next investment. I would scan through this list and do my research until I come across something that was worth my attention, and hopefully that would interest others.
My first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man!
Well, it's
okay.
But I just want your audience to think for a second.
Okay.
The answer is about $400,000. So if I, as a little kid, had taken that $114 I'd saved on shoveling snow or whatever I'd done, $400,000 today, one person's lifetime.
So there you have it. We hope that was surely interesting for you, but most importantly, that you were taking note of the higher wisdom that Warren Buffett has given us. The great thing about Buffett's advice? It's free. So you really have no excuse. Make sure you throw me a thumbs up down below and do subscribe to the channel, the #1 investing channel on the line today. See you in the next one.